So the mistake I often see owners make is they don't start planning for an exit, which is inevitable for everyone. It doesn't matter if you're a family business, you're going to pass to the next generation, you're still exiting to give that business to a family member. Or if you're going to do an ESOP, which is a way you can sell your business to your employees. If you're going to prepare to shut it down one day, liquidate it, or go through a proper sale process to sell it as an ongoing business, that's really your only options. And so you need to have a plan for how you're going to handle that.
Okay, we're back with Expandable, another episode, and excited to have Jason Godwin, M&A Advisor at Florida Business Exchange, on the show today to give our audience some timely advice on what they need to know when selling their business. I'll give you just a little clip about Jason. He's been in the M&A advisory business for over 13 years, helping owners with companies that range from 5 million to 50 million exit their business. And he's worked with all kinds of businesses, but has a deeper expertise in automotive, liquor licenses, retail, route sales, agriculture, construction, and trade industry. So we're happy to have him here to share some of his insights and wisdoms with us. Jason, welcome to the show.
Lee, Ryan, thanks for having me.
Yeah, thanks for being here, Jason.
I should also mention that you are a business owner yourself as well. Is that right?
Right. Yeah. So I have two companies. So I have a lead generation agency that focuses on B2B lead generation, but my primary focus is on one of the managing partners at FBX. And so I own a portion of that firm as well. Got
it. I thought we could start our conversation with a stat that you mentioned in our pre-call that was like shocking to me. Just the number of businesses that are for sale, number of businesses sold in the state of Florida, because that's where most of our audience is. And that's where we're doing business, and that's where you're mostly licensed. So let us have it. Like, what's the market look like in terms of volume of businesses for sale?
Well, so I'll pull up the live stats. So 2024, there was a total of 1,143 businesses sold in the state of Florida that was recorded in the MLS. Now, there may be some that are off market, some that sell to employees. With a real estate transaction, they're all publicly recorded because you have a deed and title has a transfer. So there's a property appraiser's office that tracks that. But with business transfers, that information is not tracked publicly anywhere. So there's self-reporting databases that people pay to have access to, and they must also report their listings. And that's where we get these comps from. So on average, like right now, there's 2,469 businesses for sale in the state of Florida. Year to date, today's October 16th, 767 have sold. And that's kind of one of the stats we've talked about is there's this large demand for quality inventory, so good businesses to sell, but there's a lack of supply. There is a lot of smaller companies that come to market that are single owner operator with maybe one or less employees. But what the market really looks at for is companies with 5 or more employees where the owner's not the primary decision maker. And there's just very few of those companies that go to market. So for the owners that have those companies, there's a huge demand for their product.
Are you seeing now, since we're post-COVID, that there's been a lot of changes in their income streams in the businesses that are marketing for sale now?
Certain industries. So restaurants, hospitality, any industry that is dependent upon food as a cost of good or is very sensitive to the labor market. We saw cost of goods rise during COVID and didn't really come back down. We also saw pressure on the labor market with the increase of minimum wage in the state. And so what we've seen, like what that looks like on the back end is those businesses are less profitable than they were pre-COVID. A lot of industries were unaffected. They, if they had a B2B client or if they had a home service type client, they continued to grow and expand. These days, my primary focus is construction, home services, so HVAC, plumbing, roofing, and B2B services like accounting and outsourced business process. So those sectors were almost completely unaffected unless your business it touches anything to do with interest rates. So if you offer a product like solar, where somebody finances the end product, or if you do home remodels where people pull home equity lines to remodel their home. Those businesses we've seen in 2024 started being affected because it seems like there's a lot of people waiting around for rates to drop before they make these big decisions. So we have seen that change. But outside of that, it's primarily been wage driven and cost of goods increase driven.
Okay. Interesting. Now, where do you see, there's talk about a possible depression, or not depression, but a recession coming, or, there's lots of talk about the market fluctuating here in the next year. What does it look like from your vantage point and the numbers you're seeing, where the market's going?
So we'll talk about, there's two different parts of that equation. So the first part is the inventory itself, so the business we're selling. And the second part of that's buyer demand. So I'll start with buyer demand. Right now, buyer demand's all-time high. If we look back to, say, the early 20 teens, there was a large social media focus on becoming a real estate investor, passive income, learning how to buy rental properties, flip properties, right? And the timing was perfect. It came right on the back of property prices being depressed from the financial crisis. And so lots of people saw opportunity in that market. And the result of that was increased amount of buyers in the market. So we saw like property prices went up, cap rates went down. For those who don't know, cap rates rate of return you make on investment property. So it became more of a seller's market. We're seeing the same thing happen in the business acquisition space. It's become more popular now. People are becoming more aware. You can do what's called ETA, entrepreneurship through acquisition, where you can leave your corporate job, get an SBA loan, purchase a business. You can pull some equity out of your home. You can liquidate your 401k through a Rob's rollover, and you can take that investment and become a business owner and then work for yourself. So we see lots of people who make that decision. So on that side of the market, it's very, very strong. We do see isolated sectors where there's downward pressure, financial pressure on some companies, where we had some companies that we started working with at the beginning of the year that started having a bad Q1, Q2, Q3. And the conversations we've had, it's all been the same, which is pretty much what drives most either up markets or down markets. Is it's all about consumer confidence. So when the consumer becomes less confident, they go spend less money at their local restaurant. Local restaurant has a harder time making capital investments into their space. Then the company that does those capital investments, say an HVAC company, then doesn't have as many service calls. And so it all kind of connects to the local economy. So again, it seems to be very isolated. So if it's a lot of people are waiting for there to be a change in the market as far as rates to make large financial decisions, or things to say stabilize in the global economy or the global geopolitical space. Without knowing that, typically when that happens, prices when demand goes up, prices go up. So, for example, people waiting to buy a home, as soon as rates go down, home prices will go up. That's just how the market works. So there's a lot of people, I think, on the sidelines not making larger purchases. But then there's hundreds of industries we work with that are completely unaffected and having the best year ever. It's very isolated to specific industries, and a lot of it seems to be circulating around interest rates.
Gotcha.
On the lending side, we see the same thing. Less people, they're waiting for the rates to go lower, and prices are getting better, but they're still waiting. They're waiting for another quarter. But historically, over the last 30 years, we're still in a good rate environment. But we were in such a low one, and it came out, and everybody resetting 4 and 5 years ago. It's made a huge difference.
Yeah, I think people have a very short memory. When you look at the history of what rates were, like when my parents purchased their house, they paid 16.5% back in 1984. I was able to purchase my house at a 3% rate, which is, below inflation, which is, unheard of.
For 30-year fix, too.
Right. So I think there's a generation of people that lived through, or they became adults through the recession, that have that as a framework of how they're making decisions without looking at the longer trajectory of seeing how capital markets work. And the reality is, like, market sets the rate. And because demand for lending products is so high because of people either wanting to make decisions on moving, acquiring assets, growing their household, and there's such a demand for lending, it's going to drive rates up because there's demand for capital. And so, and plus with, the effects of what happened during COVID with the federal government injecting a lot of capital in the market, of course, that created some, inflationary measures. So I think I am very bearish on seeing rates come down much more. I think as soon as they pull rates down, demand goes up. So I think this is kind of here to stay for a while. And I think we have to learn how to operate with where prime is right now. And that may depress some prices of assets and kind of have a pullback from what happened after COVID. Again, people have very short memories of how markets work. And so they want to look at the last 3 years and make decisions on that. Like, well, I should have bought a house in, 2020 or 2019, or I should have done this, or I should have bought a business. When the reality is, you need to deploy your capital now, because that is, you need to start making decisions to grow either your business or grow your income and investments, because waiting for things to change is not going to replace the inflationary pressures that inflation puts on your net worth.
Yeah, that's exactly where I was thinking as you were talking, wondering what your advice is for owners who are in businesses that are affected by rates, where the customers aren't, pulling the trigger because of rates, because, for one reason or another. How would you advise someone that's getting ready to sell or now thinking about selling or in the process of selling, to be thinking about their business in terms of, well, rates are, creating an issue for you, potentially for your customer base, but you still have to move forward.
Yeah, there's a lot to unpack there. So there's some markets that are just highly competitive and are very price sensitive and are going to be affected by rates. For example, if you're in the underground site development, site preparation industry where you're clearing home pads and doing neighborhoods, you really don't have a way to drive revenue. You're basically subject to what projects are coming through permitting and have approval, and then the developer's ability to borrow money, and you have to now go borrow money to buy equipment, right? So you're kind of subject to the market. You don't have a lot of control there. And you just need to know that about your business. Now, if you're in a business that you can pick and choose the type of clientele you work with, then you have to really start looking at who is your ideal customer, and is that ideal customer evergreen and have the ability to continue to grow with your business, or is it very cyclical and attached to rates or the economy? It's just, you have to have these hard conversations with yourself. That you kind of understand what's the reality of your business model. Mm-hmm. For example, if you're in a brick and mortar business, you, like a lot of businesses here in downtown, you're kind of limited to the what traffic comes downtown. So you are subject to what that economic environment is. Yeah. Or if you're an online business, you have the ability to go solicit customers that are strangers that don't know where your physical store presence is. Mm-hmm. And so just understanding where you are in that spectrum will allow you to make better decisions on how to move forward in planning an exit. So the mistake I often see owners make is they don't start planning for an exit, which is inevitable for everyone. It doesn't matter if you're a family business, you're going to pass to the next generation, you're still exiting to give that business to a family member. Or if you're going to do an ESOP, which is a way you can sell your business to your employees. Mm-hmm. If you're going to prepare to shut it down one day, liquidate it, or go through a proper sale process to sell it as an ongoing business, that's really your only options. And so you need to have a plan for how you're going to handle that. We often find people believe it's like real estate, that I'll just throw a sign up and because I've been here 30 years, people will be excited for my business. And I had 3 very hard conversations with clients this week. And during those conversations, I kept hearing the same thing. I've been in business 31 years. And my rebuttal is, well, buyers buy business based on spreadsheets. They don't care how long your business has been there. So if you've been there 31 years and you haven't grown, that's a sign the business has reached its maximum capacity. People also say things like, well, if someone just did this, or if they just made this investment, the business would grow. It's like me pulling up to a vacant lot with you and saying, hey, this is zoned for multifamily, so I want to price it based on what it's like when it has a fully built apartment building on it.
Yeah.
And that's so you have to have a real understanding of what your business is, how it's valued in the market. Because it's just like real estate or selling new cars or selling any type of asset. There's two things that set the market: the buyer's demand and desire for that product and their availability to capital. And so those are the two things that limit the value of that asset. For example, you can have a situation now where you have huge buyer demand for real estate, but the limitations on capital because of where interest rates are putting downward pressure on the price. A homeowner they can only spend 28% of their salary on a mortgage. So that limits how much they can pay for a house. In a business, the SBA limits it to a portion of debt, what a debt coverage ratio is. So they have to have below either 1.5 or 1.25 debt coverage ratio after they pay their own salary. So it doesn't matter if your business has been there 31 years. If it makes $150,000 a year, it's only going to be worth, X amount because of how much debt the business can hold. And so I think owners have to have a reality check of knowing the market sets the price. And so you need to know what the market thinks about your business before you plan to exit, because maybe you don't need to go buy a new truck every 2 years. Maybe you need to max out your 401k. And maybe your business will not be the sole thing that funds your retirement. Maybe you need additional strategies to do that. And I'm often disappointed with the amount of CPAs that don't have this conversation with their clients. And so their clients are in their mid 50s, early 60s and have zero plan for an exit, have zero preparation. They're not maximizing any of their tax strategies. They're not maximizing any of their investment strategies. And they come to me and say, well, I need $10 million for my business so I can retire. And I have to tell them it's not going to happen.
Yeah, very well said.
Yeah, it's we're having the same conversations in a different way over here. I got a question. Out of this successful business deals that go through, what percentage of them do you see where they get in their financing? Are they getting through a traditional bank? Are they going through fintechs? How are just standard SBA? What are you seeing on the financing side when they do, and the progression over the years?
Yeah, so to answer that question, I'll break deals down into three categories. So the first category we'll call Main Street, right? So that's businesses that are valued, say, under $2 million and down to $50,000 is kind of the smallest transaction as a firm will see. A lot of those deals, especially sub-$1 million, are very seller financing dependent, meaning the seller is contributing to the financing of that business, typically for one of two reasons. So because SBA products are very expensive to maintain, the cap for many SBA lenders is $500,000. They won't go below that. And a lot of them have moved that up to $750 because of, again, this is the cost, what it costs to maintain an SBA 7A loan. So if it's a sub $500,000 transaction, it's going to be seller financed in most cases. There's a handful of lenders that'll do deals between $350 and $500, but you're going to pay a premium on that because it's a more expensive deal to maintain. So again, seller financing becomes very critical in that point. So as a seller, your goal is to get that number above 500 as fast as you can, so that you have a less likely to have to participate in financing that deal. From 500,000 to 2 million is almost always SBA. We'll have conversations with sellers and we'll tell them, well, at that price point, it's not SBA financeable. And they'll say, well, why don't they just pay cash? If someone's got $2 million in cash, they're not buying a $2 million business. They're buying a $10 million business. They're looking for leverage. They're not looking for a job. So we have to set the reality there. So yeah, from 500,000 to 2 million is a lot of SBA. When we get north of 2 million, let's say 2 million to 7, 8 million, there's a mix of seller financing and SBA and some, say, earnouts or pari passu loans, because SBA maxes out at 5 million. There's hopefully some provisions that are going to bump that up to 10 soon, but per NAICS code, it's going to be 5 million. So anything above 5 million there's some either seller participation or there's a pari passu loan that goes on top of that SBA loan. The world I work in mostly these days is that, say, north of 8 million, 10, 15, 20 million range, where a lot of that's private equity. And some things that are very important for owners to know about private equity is the type of buyer that's coming in is expecting a turnkey business that has a leadership team in place. So if you are the primary operator of your business, meaning you own the outcomes of the business, you should expect to stay on 2 years after selling that company to private equity. So owners often find themselves in this trap. If they're sub 500,000, they have to finance the sale. If they're above 8 million, they have to stick around for a long period of time. And so again, it comes down to, this isn't something you can wake up the next day and decide to do. You really have to spend 5 years planning it to know exactly what the outcome is going to be. And so the gospel I try to preach is you need to have these conversations as early as possible so you're prepared. It's kind of like you don't wake up at 60 years old and go to the cardiologist for the first time. It's not a good plan.
Yeah, that's very helpful, in my opinion. I think it's just the medicine of taking that medicine. I think if you're in that situation, you think your business is worth 5 million, but maybe it's worth $1.5 million, and now you're looking at these options of how someone can actually buy it. Once you digest that, though, I think that makes a lot of sense. I mean, that's good for people to hear. A lot of what you're talking about is business owners not being prepared to sell. What are some of the things that they can do to start preparing? I mean, first of all, that's a hard one for people to swallow because they got to shift their mindset. But now let's say that you're talking to someone that's like, okay, I get it. And let's say they're at the $1 million to $2 million mark, and they're looking at, they want a bigger exit to fund retirement, and that's coming up in 10 years. What's the plan?
Yeah. So we do some advisory work in this space. And the first thing I do with our advisory clients is, I said, the first conversation is about humility. You have to envision a future without you in your business. Mm-hmm. And a lot of us entrepreneurs, we take a lot of pride in the things we've built, the things we've run, the things we've designed, the teams we've built. And so there's a lot of ourselves connected to that business. Picture a business as a puzzle with hundreds of pieces. The owner's role, the size of the owner's role in that business, imagine that as a group of puzzle pieces. So when you remove that, how much of that puzzle's left? Mm-hmm. And so the very first thought process you have to have is, okay, I can't have my identity attached to this business for a few reasons. First, because it has been run without me. And two, I need to move all of my emotional connection to the value of my business and become more objective in how I think about it, so I can make these wise decisions over the next 5 years, planning for my inevitable retirement. I think that's the very first step is understanding that if your business cannot run without you, then you don't have a sellable business. That's step one. Step two is having a very frank conversation with your CPA and your accountant, and say, I need to have financials that are updated within 90 days, no matter what time of year it is. I need to have a pulse on exactly where my business is. I need to have a pulse on exactly where my balance sheet is. I need to have a pulse on exactly where my chart of accounts is. And all of that has to be up to date with no exceptions, with being no further behind in 90 days. Mm-hmm. The reason being is CPAs have a very hard time hiring right now. So a lot of them are very far behind. For example, we had a large amount of our valuations being completed in October because many of our clients were stuck waiting till the September 15th deadline to get their 2024 1120. So 9 months to get their 1120. And that means oftentimes there is catch-up bookkeeping work that the accounting firm is putting off doing because they simply don't have the bandwidth or manpower to do it. And so that conversation needs to happen 2-3 years out. That, hey, I'm planning this. This has to be the cadence. I have to have financials that are 90 days old or newer. And if not, you have to find a new CPA. You just may not have the right firm for you. And then the second conversation was then we need to start thinking about tax efficiency in a way that doesn't prevent or lower the value of the business. So, for example, how do we become more tax efficient and make sure that the balance sheet is not affected when the sale happens? I'm not paying too much in taxes when that sale does occur, but I'm also doing it in a way that's growing my net worth at the same time. And you may need to, again, find a new person to have that conversation with. We have a network of 20 CPA firms around the country that we refer people to that can have those conversations and actually deploy those strategies. And then from there, you need to start thinking about systematizing the business. What are the things that you do on a daily basis that only you can do? And why is it that only you can do it? And that's something that affects not only the value, but the profitability of the business. Because if you are the main restriction and choke point in your business, I can guarantee there's people who are waiting on things in your company that could execute it at a higher level and faster if you removed yourself as a choke point. And so having a list of things each week, what am I focusing on? And making a list. Do I need to automate this, delegate this, or eliminate this? Every single week, make that list. Because if you, and again, if you're planning to sell a business in that $500,000 range, that's not as critical. But if you want to have an exit in that $5, $10, $15, $20 million range, this is very, very critical steps to take.
I think you make too much sense there, Jason. I mean, we've talked about these things like, business owner, when you want to own a business, that you've got to do from day one is know your business and your numbers. One thing that caught me, we were talking about, I've had to have the conversation over the years when people were selling their properties, and they've constantly refied and cashed out over the years, which is a good practice because they're able to, use the funds and not pay income tax. But then they don't realize their basis on their property is nearly zero. They owe several million. Maybe they're selling it for a few million more, but they don't realize that they got to pay so much in taxes. Have you seen them run into that?
Well, I'm going to preface this is not financial advice. This is not legal advice. I'm not an attorney or a CPA. This is just what I tend to see. People try to find ways to be tax efficient in a way that increases cash flow to them personally, without understanding the downstream effects of what happens to the balance sheet. For example, how that affects a business is 179 deductions. I can't count how many contractors I know that buy a brand new F-250 every 2 years. They're spending 80, 90 grand, taking a 179 deduction, taking the value down to zero, kicking the can down the road, essentially. But I almost 90% of them don't have a solo 401k or a 401k at all. So they're investing in an asset that's going to depreciate by 30% the first year. They're depreciating it down to zero. And then when they go to sell that, they have to then report to the IRS the fair market value of all the assets that were sold. And when you have a discrepancy between the fair market and the book value on the balance sheet, you have to pay recapture tax at your income tax rate. Now, here's the catch. Say you've been in a 22, 24% tax rate for the last 10 years. Well, the time you go to sell, you're going to be in the highest tax rate because you're having a large financial event. So you saved 22% to 24, 28% when you bought that vehicle. Now you're going to pay 37 on it, recapturing it. And no one had that conversation with them. So here I am. If there's one thing you get from this podcast, you need to stop doing that, because all you're doing is creating a financial liability down the road. Whereas and I'm not a financial advisor, so this doesn't monetarily benefit me at all. But if you take and you max out your 401k each year, we can add that back as an adjustment to show an increased seller discretionary earnings to increase the value of your business, while also reducing your tax burden and being able to take that, because the employer match portion is 100% deduction, right? So that grows your net worth. And then when you go to retire, you have an additional buffer against the value of your business to help prepare you for retirement.
Yeah, that's a lot of truth right there. I mean, everyone listening, if this is the first time you're hearing this advice, it's like you need to go back and listen to this like 3 or 4 times to really have it sink in, because it's very, very sound advice. And
it never fails. I think 9 out of 10 times out of the 25 years of customers that brag about the depreciation immediately one time in their vehicles and doing it regularly is a higher chance of default on their loans. I mean, because they're not looking past, like, it's like, okay, you truly don't know, the cost.
Yeah. And that, go ahead.
Yeah, I would say the other thing too is I think a lot of owners don't understand the difference in W-2 wages and distributions. So when they're calculating how much money their business makes, they'll tell themselves, well, I took $200,000 in distributions and my net operating income was $200,000. And so I made $400,000 this year. When the reality is they don't understand that distributions come out of net ordinary income already. So you pulled that $200,000 as a balance sheet item. So if you're not paying yourself a W-2 wage, you're not able to contribute to your 401k. You're not also getting, the QBI deduction, which saves you on your payroll tax. And then you're also truly not understanding how much money your business is making. So you come to me and you tell me, well, I made $500,000 last year. And then I come back and say, we actually made 276. And then here's why, because the spreadsheets don't lie. And it's not what it's what you can prove. Buyers are only going to pay what they can find. So they're going to pay for a multiple of seller discretionary earnings and adjusted EBITDA.
Do you have any strategies for a buyer that's having that discussion with the seller where it's like, where you don't want to offend you can't offend them because they may have a wonderful business, but they still have that hard time and have this valuation that is, maybe 50% higher than what it should be because of that cash flow reason, and that they can't separate themselves from the business.
Yeah. That's the beauty of having a advisor in the middle of the transaction to be the buffer and also be bad cop when needed. And I have buyers come to us all the time and they'll tell us, I really prefer to buy a business listed through a broker because when I don't, I have to be the one to tell the seller the bad news on their valuation expectations. When you have a broker involved who's objective and can say, well, here's what the data shows, then it becomes a much different conversation. And so I think for the buyer, looking at on-market businesses that are listed by reputable brokers that have a long-term track record in the market and they know what they're doing. So that because here's how that affects a buyer. A buyer pursues a business. There's only so many opportunities they can chase at one time. They have an amount of capital they have to spend for the due diligence. So they have a CPA firm do the investigation for them, or a law firm do some investigation for them to determine if the business is sound. And here's something that sellers need to hear and understand. When you're buying a piece of real estate, from my desk here, I can make every decision I need to buy that property. I can hire an inspector to go out and inspect the building. I can have my law firm do the title search and give me any details on the title or defects or any liens. I can have a foundation firm go inspect for sinkholes, have an environmental firm do a phase 1, phase 2, and I can, without leaving my home, I can make every decision I need if I can purchase that property within 1 to 2 days. On a business, that's not the case because all of the value is unseen. So I can't touch it, feel it, see it. It's all comes down to the financials and the understanding of how the business operates and its true position in the market. And that then comes down to the accuracy of the financials primarily. And so the buyer is going to be hiring an outside CPA firm to do that research and to determine if the business is viable. So if a buyer goes to a broker that's not reputable and they look at a listing, and then they spend that money to investigate that only to find out that the information was unintentionally misrepresented because the broker didn't do their investigation, now that buyer has incurred costs they cannot recover because they have to now separate the seller from their price expectations and bring them down to a real price, which most likely isn't going to happen. So because the seller went to market with the expectation of getting that large number, and now when they find out it's 50% low, they're just going to anchor themselves and say, well, I'm going to wait for the right buyer, because they don't fully understand how these deals are funded and capitalized, because they weren't educated, because they didn't have an advisor alongside them who had their best interest in mind.
It's awesome. This is amazing. I mean, lots of sound advice here. Just for kicks, what's the coolest or most interesting business that you've worked on and gotten sold? And you don't have to tell names or, or anything like that.
So my most interesting business by the type of business or, for me,
type of business or transaction.
Yeah. The most enjoyable projects are all based on who the sellers are. Mm-hmm. When I have a group of sellers that I work with that is very in tune with the process and they're just really good to work with, those have been my favorite transactions. Mm-hmm. I'll tell you one though that this past year was my favorite, and it was because of the win we got for the client. So there's a large landscaping company that was based out of North Florida. We had approached because we do a lot of outreach to approach our clients. Because a lot of people don't know we exist. They don't know that this solution can help them retire. And we approached a firm that we had been made aware of, and that firm had previously been to market by another brokerage. They had attempted a sale at $6.9 million, and this company was about $9.5 million in revenue and about $1.67 million in EBITDA. So EBITDA, for those that don't know, is a measurement of cash flow, similar to seller discretionary earnings. All those two things mean is how much value the business brings to the seller, and then adjusted EBITDA is how much value that business would bring to an investor. The only difference is, are we taking owner comp into play or are we not taking owner comp into play when calculating that? So we approached the seller. The seller was very apprehensive working with the broker because the broker that he had worked with had brought him a buyer that was an investor that was raising the capital to buy the deal, which is very common these days. Just like in investment real estate, you have people who try to syndicate deals. They'll lock a deal down under contract, and they'll go try to then raise the capital to buy that deal. Mm-hmm. Well, the broker had not vetted the buyer to know if they had the capital before going under an exclusive LOI, letter of intent. So the sum of that was the seller was off market for 8 months while this buyer was trying to get their stuff together. And during that time period, the buyer never engaged a quality of earnings firm. They just basically kept the seller stuck in an exclusive LOI because they were ill-advised by their broker and did not know the buyer wasn't fully qualified. So we come in on the heels of that and earn the seller's trust. He gives us a very short time frame on our agreement to go make this happen. So in that time period, we run what's called an M&A auction. So for smaller businesses, $2 million and under, it's very common to put a public-facing price out. Buyers would then inquire based on that price. In an M&A auction, which is mainly what I do, we go out to the market and go find active private equity buyers, and we solicit them to make a bid on the business with no public-facing price. So it's a very different process, and it's very common in what's called lower mid-market. So the deals from $5 million to $50 million. It's primarily my method of selling a business. If we anchor the price, the buyer is always going to be trying to get a better deal. If we're doing an auction, then the buyer is competing for that business. So we run this auction for this client. We secure 13 bids. We end up with the final 3 we're negotiating between. And the result of that was we sold that business for $9.2 million in a matter of 5 months from start to finish. And that in the very beginning, the client was very apprehensive because of their previous experience. But since then, they have sent us several other clients of similar size that we're now working with because they had such a great experience with us. And so for me, that was one of the most rewarding because you had a client who was very frustrated, who was stuck and couldn't retire and was going to end up with a $6.6 million deal. And we turned that into a $9.2 million win with better terms for them just because we changed the process and we actually know what we're doing.
It's amazing.
Fantastic.
Yeah, that's awesome. That's cool. Well, I'm sure you've seen some stuff. You've been doing this for over 13 years. And there's all kinds of craziness out there. But it's cool to see that you can have wins like that. And, the difference, the delta between what they would have retired with, or what they are retiring with is pretty amazing. I mean, that's really life-changing.
Yeah, no, it is. And that's the most rewarding part about what I get to do is help owners walk through that transition phase of being active producers in the business to trying to enter retirement and being an advocate for them, and helping them make that, that's a very challenging transformation of their life because they've spent a large portion of their life investing solely in this business, sacrificing time with family, sacrificing vacation, taking large financial risk to grow a company. And oftentimes where they're villainized for being successful, they don't have a lot of people in their corner advocating for them. And so for us, we have that opportunity to walk alongside them in one of the most important decisions of their life and help them make that transition. And so that's why we do what we do.
Now, you mentioned you work with PE firms for putting deals together for your seller. Do you work on the buyer side as well for smaller deals? Like if you had a buyer, like you mentioned, has $1 million or $2 million, and they're looking to buy something, or even a smaller amount, do you work with SBA lenders and kind of try to put that deal together for them?
So we have in our firm, we have agents who do work on the buy side. I primarily work on the sell side. I may take one or two buy side clients per year, but the majority of my work is on the sell side. But then we do have agents in our firm that their primary focus is on the buy side. So we can place them with someone who can take care of that for them. But yeah, we do. When we bring in a buy side client, we will first vet them and screen them because we have to make sure we're setting expectations that they're qualified so that we're not wasting their time. We're not trying to put them in front of deals they don't have the ability to close. And then if they're seeking SBA financing, we put them in front of an SBA lender. We have about 40 or 45 or so lenders we work with, and the mix of regionals, internet-only banks, and then match them with someone who's a good fit for them and help them get qualified. Because if you're buying a business, it's just like buying a house. You should come with a pre-qualification letter before you go see your first business so that you're not wasting your time or the seller's time. You know exactly what kind of transaction you can close. So that's one of our recommendations. And then the broker would then help them investigate the market, find what businesses are a fit, because it's not just whether you like the businesses, do you have transferable experience? Can you run this company? The owner's been a large portion of the operations and ownership of the outcomes of the business, which is going to go away. So the buyer needs to be prepared to jump into that seat and within 30 days run that company. And so it's crucial, I think, that you match a buyer based on their experience to a business that they're going to have a high success rate in running. Because again, if you take on an SBA loan, if those who don't know, you are taking also out a personal guarantee that you will pay that loan back. And the bank is going to take a second position on your house. So you are putting a lot of skin in the game to make sure this deal works out. So you need to make sure that you're not coming in half-cocked, that you're finding a business that you're qualified to run and not having a fantasy that this is like a real estate investment, it'll run itself. I have yet to find a business sub $3 million that runs itself. So, and even then you also have to understand if you're looking for, an absentee owned business, you're competing against the very top point of the market because everyone wants that opportunity. And so you're probably going to get beat out by somebody who's paying cash and can pay a higher multiple than someone who's limited SBA loan and is going to be capped out at a smaller multiple because of the debt coverage ratio. So just know that when you're in that $3 to $10 million price range, you're competing against private equity. So buyers need to understand that landscape so they're prepared to go to the market.
Do you see, just kind of came out of my brain, like under the 1 million mark, do you see a lot of entrepreneurs, like opportunists that have figured out in certain niches where they can spin up a company and sell it, either through seller financing or through the SBA because they understand the SBA process? Does that happen a lot?
Not typically, because when you sell a business, you have to sign a no-compete. So you're limited on being able to spin that business up again. We'll see restaurateurs will do it because they'll just move around. So they'll go. There's a family I can think of that I've seen do this recently. So they'll go start a restaurant in a certain niche that they know, and they'll develop that, and then they'll get that where it's running. They have family members in it running it. They'll go start another one. Yep. They'll let that one run for 3 to 5 years, and then they'll sell that one, and they'll space them far enough apart that a market rate no compete doesn't overlap, right? And that's typically based on radius, not drive time. So you need, typically local businesses 5 to 10 miles for 3 to 5 years. When you go to, like, say, an HVAC firm, you're going to have a 5-year 100-mile no compete, right? So for 5 years, you got to go find something else to do. You're not going to be able to go spin another one up. And sometimes that's also not just
now, Jason,
100 miles from your it's not just 100 miles from your location. It's 100 miles from your buyer's location. So if you sell an HVAC firm to a national HVAC platform, they're going to expect a no compete within 100 miles of all of their locations.
Jason, are you seeing a continued, what percentage are franchises? Because even in like the land over the years, and I've noticed, because primarily commercial real estate lending is what we're in, is majority of those being built are franchises. They're national flag coming in throughout the town. I see less and less single operators.
Yeah.
Are you noticing the same thing?
So I myself, I do not work with franchises. Okay. There's other brokers in our organization that do, so I'm not the best person to speak on that. I do know that with lots of franchises, if you read the FDD, there's language in there about what happens in the event of a transfer of ownership. And oftentimes the franchise has to take a large role in that, and sometimes you have to use their team to do that transfer. So I've never focused a lot on them. I came from the franchise world. I spent 8 years owning franchises, and I find that they are somewhat difficult to navigate because they kind of want to drive the bus on everything. So it's not really something I focus on. Okay.
Do you think that's a large percentage out of that 1,100 that we talked about, the stats earlier?
I don't think so.
Okay.
It's a percentage, but I don't think it's a large percentage. We see a lot in that sub $1 million price range. So a lot of, say, health and wellness, restaurants, pack and ships, that type of, it's very common. So there's something called an E2 visa, where investor visa, where you can come over to the United States and get your citizenship status through acquiring a business. It needs to have at least 2 employees, at least a 2-year lease, and certain amount of fixed assets. We see a lot of pack and ships that do that. So someone will buy a pack and ship, they'll run it for 3 years to get their permanent resident card, and then they'll sell it to someone else who's doing the same thing. And so we'll see those every 3 years turn over. And some of those are franchised. You'll see things like printing franchises. And there's several out there that we've, as a firm, have worked with that are good to work with. So I know, like, for example, Herb, our president's done a lot of them, so he would be a better person to speak to that. But it's not a world I find myself in much, with my focus on home services and HVAC, plumbing, and roofing.
Gotcha. Thank you.
Jason, this has been a very valuable conversation for me. I know I can speak for myself, but I know for our audience listening. So I really appreciate you coming on and sharing your advice with us.
Yeah, thank you, Jason.
Anytime. Happy to do it.
If we want to send people your way, where do we send them?
Easiest place to find me is probably on LinkedIn. So Jason Godwin on LinkedIn, or you can go to our website, fbxbrokers.com, and you can find, all about us. We have a, bunch of great advisors all over the state. We have 5 offices. We have Jacksonville, Daytona, DeLand, Lake Mary, and Tampa. And we also have, we have some people in South Florida as well. So we cover the whole state. We have a bunch of great agents that we could hook a seller up with, and that can help them walk through that, or a buyer, help them walk through that process.
That's awesome. All right. Thanks again, Jason.
All right. Thank you so much.